Charlie Munger says Bitcoin should be banned, and Ray Dalio has a thesis that the world's monetary system is going to collapse. Is this going to be like the Great Reset? What the heck are these old dudes talking about? And do they potentially have a point? Well, let's watch. Starting in this video. Keep in mind the coupon code has been extended to tomorrow, so if you want to join the programs on Building Your Wealth, do so using that link down below. I'd love to see you there. Every day the market is open. We do a course member live stream. We do fundamental analysis on real estate stocks, TA. I answer your questions and help you understand what's going on in markets. So join me in person in those course member live streams and get lifetime access to all those lectures on Building Your Wealth for the long term. Check those out, link down below. Ray Dalio no longer thinks that cash is trash. Ray Dalio now actually thinks that cash has a substantial potential opportunity premium over really any other kind of investment. And that's mostly because Ray Dalio thinks that U.S. Treasury yields should remain high and are likely to remain high. This is exactly the opposite of the trend that we've been seeing in Treasury yields. Treasury yields have been falling since about October and mid-November when we sort of had a double peak on the 10-year Treasury. They've been straight down since then. We peaked out around 4.25, now we're sitting at under 4.5. 10-year Treasury yield at the time of this recording sitting at about 3.38 after dovish comments from Jerome Powell. So far, this trend is inappropriate to suggest that, well, Treasury yields will actually stabilize. I think this is because Ray Dalio doesn't really believe Jerome Powell and the Federal Reserve are going to cut interest rates and instead believes that you've got to keep interest rates high. Maybe you shouldn't actually extend the debt ceiling because, after all, you should operate the government like a business or a household, which on one hand makes sense. That's relatable to us. We shouldn't spend more than we make. But on the other hand, the reason politicians spend more than we make is because it promotes growth. And when we promote growth, we are not in a recession. Businesses grow, people flourish, businesses are able to expand, people are able to start new businesses, households build their wealth, people are able to buy a home to live in rather than renting for their entire life, which I'm a big fan of, obviously building your wealth through investing in real estate. And so governments are clearly incentivized to actually, yes, spend more than they make. That's why our debts go up. Now, eventually that'll collapse. So that, again, there's been no currency in history that has survived. In other words, they all collapse. It all ends up being a house of cards. Is that a house of cards that we have to worry about within the next few years? Probably not, because the dollar is still one of the strongest, I think arguably the strongest currency in the world. And if anything, decisions by the Bank of England today, where the Bank of England is expecting a recession, a mild recession, but they are expecting a recession out of G7 countries. Statista shows that the United Kingdom might actually be the only G7 country to fall into a recession. But what did the Bank of England do today? The Bank of England actually hiked rates by 50 basis points. Which were not fully priced in, leading to a rally in the pound sterling. And the reason you get this and the reason it matters to the dollar is because the more other countries, everything's relative. You have to remember that when it comes to currencies, okay? The collapse of the dollar would probably be the last collapse of currency you would expect. You would expect the Turkish lira with over 60% inflation to collapse way before the US dollar. Obviously, right? We would expect a collapse of many other currencies well before we would expect a collapse of the euro before we would expect a collapse of the US dollar. But when we look at this relatively and we consider that if the United Kingdom is the only one expecting a recession, as the Bank of England continues to fight high inflation and they continue to hike more than expected, what ends up happening? Well, you end up driving up the yield of gilts, which are basically treasury bonds in the United Kingdom. And when you drive up the yield for those, you actually lower the demand for treasuries and the dollar and other bonds around the world. And on one hand, when you lower demand for bonds over here and you potentially lower prices here, on one hand, maybe Ray Dalio could be right in that, okay, well, if you have less demand for bonds in America, yields are going to stay a little elevated because higher yields will help increase will help increase demand, essentially. And if rates are expected to be even higher in the United Kingdom, you might get less demand in America and more demand in sort of the United Kingdom or other countries. Now, the reason that matters, it's basically to say that in the short term, yeah, maybe we'll see some stability around the threes. But here's where, in my opinion, Ray Dalio's argument falls apart for Treasury bonds in America, which is really important because as Treasury yields fall, we expect stocks to rise and we expect real estate to rise again. Here's where, in my opinion, his argument falls apart. It falls apart as soon as we start realizing that, yes, indeed, the United Kingdom is going into a recession as inflation hopefully gets stamped out of the economy, much like we've seen that disinflation process start here in America. If we start seeing that also happen in the United Kingdom, we'll probably start seeing international yields for all bonds start falling. And that's because as inflation goes away, now more folks can start buying US bonds again, and that's exactly what people are doing. And what does that do? It drives up the price and lowers the yield. Eventually, that'll happen in the United Kingdom as well. You get a temporary boost in yields because you're seeing higher rates than expected from the Bank of England, but that too will go away eventually. So the long story here of where I'm going with this inflation fight is as inflation falls throughout the rest of the world, we do expect yields to across the entire world slowly fall. And I think that kind of counters some of what Ray Dalio is suggesting, that we're not going to end up seeing yields go down. In my opinion, the only way you don't end up seeing yields go down is if inflation continues to run hot, which, don't get me wrong, it could absolutely pop up again. But I'm not convinced about Ray Dalio's argument that yields are going to stay high and that maybe it's better to be in cash versus being exposed to some of these yields. Now, for an institution, Treasury bonds might be a great way to farm 3.5% to 4% yields. For an individual, I think one of the best ways you could farm yields right now, quite frankly, is just looking at companies like Wealthfront or Robinhood, hashtag not sponsored, but here are companies that are offering you 4 to 4.25%. I think SoFi is at 3.75 or 4%. Why would you bother with Treasury bonds if you can get FDIC insurance up to $500K or more throwing your money into one of those accounts? I think Wealthfront and even Robinhood potentially lets you get FDIC insurance up to $1 million or more by basically splitting your money up amongst other individual banks. So that way you're sort of getting $500K at each bank, depending on how many times they do it, is how much FDIC insurance you can get. So, I'm not convinced that Ray Dalio's argument is super accurate, at least not at this point. Maybe at some point in the future, when currencies collapse, that'll be the time his arguments will be right. But I'm not convinced that the debt cycle is ready to end just yet. So again, it doesn't mean you're building a house of cards. But what did Ray Dalio have to say about crypto? Well, one of the things I thought was really interesting about his arguments about crypto was that one of the best things that we could potentially see for crypto would be some form of inflation-linked coin, something that gives you a secure set of buying power. Now, obviously, immediately what comes to mind here is Bitcoin, because of the limited supply that Bitcoin has and the theory that in the longer term, essentially Bitcoin should be a large inflation hedge because there's a limited supply of it that should help squeeze the price up. Cathie Wood highly believes in her bull case that Bitcoin will become a digital gold, and if it becomes a digital gold and we even get a 40% adoption of the gold market for Bitcoin, essentially, so moving from gold to Bitcoin, even if you get that 40% adoption, plus some other aspects that she thinks are bullish for Bitcoin for its network effects and otherwise, she's got a $1 million price target for Bitcoin. So on some, count here, I feel like Ray Dalio was slightly describing Bitcoin via an inflation-linked coin without describing Bitcoin, but suggesting you should have some kind of inflation-protected coin, that people being able to preserve their purchasing power would be useful. Now, he argues that Bitcoin's too volatile, and it's only about a third of the market cap of Microsoft. But I think a lot of crypto bulls would argue that is exactly why maybe now would be the time to buy Bitcoin. It's an interesting idea, and it stands in the face of what Charlie Munger says. Charlie Munger, obviously, Warren Buffett's co-star, dare I say. And Charlie Munger wrote a piece in the Wall Street Journal today. It's an op-ed, and it's titled, "Why America Should Ban Crypto." Charlie Munger says that in recent years, privately owned companies have issued thousands of new cryptocurrencies, both large and small. and these have later become publicly traded without any government approval or disclosure. In some cases, big blocks of cryptocurrency, excuse me, are sold to a promoter for almost nothing, and then sold to with a substantially higher value later to the public without the public understanding how dilution works. Now, I think this is really useful because Charlie Munger is right. Most people have no idea how dilution works and how terrible it is when it comes to investing in companies. And unfortunately, it's a sad reality that most people don't understand it. And this is how people make a lot of money in the stock market. It's through companies going public or coins going public with substantial dilution. I think an easy way to explain to you what a dilution is giving you an example. Let's say I create the MKC. We're going to create it together, okay? Let's say we create the Meet Kevin coin. And what I'm going to do is I'm going to create 1 million coins. And what I'm going to tell you is that on the market, I'm only going to allow 1,000 of those coins to sell. And I'm going to sell those coins for $1. But keep in mind, my costs to create the Meet Kevin coin were $10. So in other words, excuse me, if I created a Meet Kevin coin for the cost of $10, I only put $10 into creating 1 million coins, right? And if I now limit the float is a very important word. In fact, it has a lot to do with the Adani disaster that's going on. When you limit the float, you could really increase the value of each share or each coin. So if I say, listen, we are only going to have 1,000 coins available for sale. And if you want to Meet Kevin coin, you have to pay $1 for each of those coins. Well, in this example, I get about $1,000 in cash, but you have been substantially diluted by the fact that there are another 999,000 coins available, which means on one hand, you've actually just created $1 million in value. You turned my $10 into $1 million in value. And the reason you could be diluted is because while there are now 1,000 coins outstanding, I could take another 1,000 and start selling them again for another $1. Or maybe even 80 cents, whatever it is. But because of those prior sales, people believe, okay, this is about where the market value is. And if you slowly trickle them out, you essentially dilute the base and you can make lots of money. This is essentially what Charlie Munger is saying. And it's the same thing that companies do, right? I mean, think about it from a company example here. If you go to somebody and you say, hey, look, I own 100% of a company and I'm into it for, I don't know, $50 million, right? I'll sell you 10% of this company for, let's say, $25 million. Well, what I've just done is if I sell you 10% of the company for $25 million, what I've just done is valued the entire company at $250 million. In other words, I just 5x'd the value of the company by selling a small slice to somebody else for a substantially higher valuation, right? This is the same thing that happens in crypto. It's the same thing that happens in the stock market. So it's really no different from that. I think Charlie Munger here is just making the argument that most people don't understand that kind of dilution that favors the original creator of the coin because there's a lack of disclosure. Although I could tell you this, there is a massive lack of disclosure in most of the SPACs that we've seen. In fact, most of the SPACs have had these insane and glorious projections only to end up proving to us that none of those were even remotely accurate. And it's unfortunate that even SPACs are able to get through the SEC and the regulatory process and end up creating the same dilution that Charlie Munger is talking about through technically the official processes. Although here, Charlie Munger goes as far as saying that because of this lack of disclosure and lack of dilution awareness from individuals, cryptocurrency should basically be banned. He goes on to say that crypto is not a currency, it's not a commodity, it's not a security. Instead, it's a gambling contract with nearly a 100% edge for the house. Now, I would argue that with the case of, let's say, like a Bitcoin, there really isn't much of a house given how just decentralized it really has become. But sure, I would argue he's not wrong when it comes to smaller coins that are created. Yeah, there's probably more than 100% edge for the house. The house wins via that dilution that I explained. And so Charlie Munger actually goes as far as praising China for banning cryptocurrencies, concluding that cryptocurrencies provide more harm than benefit. And he says that, look, the English Parliament did this in the 1700s when companies were basically exhibiting this cryptocurrency-like behavior in early stock listings in the 1700s. And when England banned new stocks from publicly trading for about 100 years, Charlie Munger suggests that the world was actually able to progress substantially from the Enlightenment to the Industrial Revolution to the creation of the United States. So in other words, dare I make this slippery slope analogy, although I didn't make it, Charlie Munger actually did. I'm just going to say it in a different way. Charlie Munger is basically saying, if you ban crypto, you'll be able to create a new United States. That's how extreme of an argument he's making. He's basically saying it's so speculative and such a robbing of value from people that you potentially eliminate the opportunity to create something as great as the Industrial Revolution or another United States. Now, that's a pretty big argument there by Charlie Munger. And I don't know how I feel about it, but I'm curious to know what you think about it. Keep in mind, Kathy Wood's got that $1 million price target on her bull case for Bitcoin. And ultimately, you have, going back to Ray Dalio suggesting that stablecoins are not great because they're kind of like fiat, which is interesting because the good stablecoins are actually backed by $1 of fiat. So maybe he's not necessarily wrong with that, except it's harder to print new stablecoins unless you get an inflow of new dollars. So potentially there is a difference there, since we're not printing new stablecoins, unless of course you're Tether. Then we don't really know what's going on. Anyway, this is an interesting point of view from Charlie Munger, and it's an interesting point of view from Ray Dalio. Honestly, I kind of wrap this one up by saying I don't know if we're just listening to two old people fuss about things that they just don't like. Ray Dalio doesn't like the government printing money. And again, a lot of people don't and think the government should run a balanced budget. Is it going to happen anytime soon? Probably not. Charlie Munger is complaining about cryptocurrency. Not a surprise. He always has. Is he correct, though, in suggesting that dilution is a big problem for initial investors and things? Abso-frickin-lutely. This is why with the company that my startup, HouseHack, we're actually selling shares at $1 per share for every $1 of cash that we have. So basically, the company is worth 1-to-1. There is no pre-dilution. We could go in and say, hey, we're raising $50 million at $150 million valuation. That would make your shares essentially get diluted down to 33 cents, right, for every dollar you put in. But that's not actually what I'm doing with my company at HouseHack. I'm purposefully preventing that pre-dilution at HouseHack. Read the solicitation at househack.com by making sure that if we raise 50 mil, the company's worth 50 mil. If we raise 75, the company's worth 75. And I'm doing that, in my opinion. It's sort of like it's twofold. One, I think it's a gift to my subscribers and the people who believe in me. But number two, it also gives me the opportunity to prove myself that I can build this company and turn it into something really incredible. So that way, when the company actually gets a market valuation, which is generally a multiple of your book value, then those people who initially invested in me win, and everybody wins who's involved. So I'm a big fan of that. But anyway, it's interesting to consider that pre-dilution argument. I don't know if it rises to the level of banning all crypto, but don't get me wrong, there are a ton of lame, smaller, scammy coins that we want to be careful of. Now, another thing that Ray Dalio told us was a warning that companies with low free cash flow in any minor shock that comes up are going to have to raise a lot of money, and you could potentially see very quick collapses of what he calls bubbles occurring in certain markets. Now, I think this is very accurate, especially in the private market where you actually haven't seen a lot of those valuation adjustments yet. But one of the issues that you have in a recession is you have a lack of cash, you have a lack of liquidity. And this is one of the reasons I think Ray Dalio is suggesting, hey, cash is a good thing. But what I think is remarkable is Ray Dalio is really providing a warning to the people speculating on companies like Carvana and Bed Bath, companies that are really heading towards bankruptcy. Yet here in the pre-market, Carvana, for example, is up 27%, and Bed Bath & Beyond is heading up 25%. These are generally unsustainable momentum rallies where the reason we get increases or spikes in these stocks is solely because more people are buying them. Maybe somebody's manipulating, sentiment on stock twits or whatever. And what's great in terms of a warning is when Ray Dalio says, look, companies that have low free cash flow are going to have to go to the capital markets to raise money. He's basically providing a massive warning that companies that are trending towards bankruptcy because they don't have free cash flow in a recession are companies that are going to suffer bigly in any kind of future little hiccups that pop up. And I think he couldn't be more right. Obviously, right now, markets are a little bit euphoric after Jerome Powell suggesting that the process of disinflation has started. But there's a reason why my goal in investing, really for the last 6+ months, has been to focus, actually probably more like a year, 6 to 12 months. My goal has been focusing on high free cash flow companies that have low liquidity risk or needs to go to the market to raise a lot of money. So high free cash flow companies, those with margin or those with pricing power, in my opinion, are companies that I really want to focus on. And so I think Ray Dalio's warning really reiterates that.